Grant, we had a poor start to the week, and it seems that the Chinese markets is playing a bigger role now in giving direction, at least to our markets in morning trade, isn't it?
Definitely, as it stands, people are looking to China to lead us out of the trouble we've been in, to lead the recovery, and so they're also looking to China for direction as to where the world markets are going to go. And as we become more and more uncertain as to where we go from here, so we look for signals from somewhere like China, which has been extremely volatile of late.
Why are we seeing this huge volatility in China? We had the market down 7% this morning, and of course over the past few weeks we've seen these very big swings in the Chinese market.
From what I understand, it's a very retail-driven market. So a lot of money flowing into that stock market is driven by credit extension, it's driven by the private sector, people borrowing money, gearing up and getting into that market, much like you'd see in a bull market in better times in our environment. So every time there's a fear that the government's going to cut back on lending, cut back on credit extension, with fear of inflation, as we saw this morning, so the market retreats and the sort of fears kick in.
Of course, we had a few results out in our market today. We had some economic data out as well. We had the private sector credit extension numbers and, of course, that trade balance. Anything market moving on there, or were we really just taking our direction from global markets?
Stephen, I think there was a little bit of direction taken out of that, but especially sector related. I think people took hope that there'd be further rate cuts coming up in October. It certainly did provide scope on regards to the inflation fears that people may have. And we saw the retailers were pretty strong today, and actually the banks as well finished strongly. However, you see within sectors, I think on a broad basis, the market is taking its cue from global markets. But on a subsector and individual stock picking level, there are definitely domestic factors that are also playing a role.
And just taking a look at some of the results we saw out, we had those Bidvest results, headline earnings per share down 13%, but probably pretty much expected in an environment like this.
Yes, in fact, I think it's a great set of results given the environment, and given that they do have a decent exposure to the motor sector as well. So a tremendous set of results. They're still paying a healthy dividend, even though they are holding back a little bit of cash for their acquisition of Nedbank. And we're also seeing a decent restructuring charge come through. So certainly a company that's ahead of the curve, strong balance sheet, strong cash flows, and very well positioned to look ahead for 2010 and for the recovery process that we hopefully going to be seeing over the next 6 to 8 months.
How about the acquisition strategy it's employing? It's bought a couple of businesses in Eastern Europe and Poland and the Czech Republic, still looking at the East for more growth, and says it wants to conserve cash but it's happy to spend on the right acquisition. Do you think now's a good time for Bidvest to be making these acquisitions?
Definitely. I think one thing we can rest assured with Bidvest is they make smart acquisitions. They pick up, if they buy a company, it's a good price and it's a good acquisition. And I think this is the perfect environment. A lot of companies don't have cash, a lot of companies are under pressure. And for someone like Bidvest with astute management and a strong balance sheet, it's a perfect opportunity.
A small announcement out from Sappi this evening that it's cost cutting, which may result in more job losses at some of its South African mills. And just your view in the cost strategy here at Sappi at the moment.
I think Sappi is a company that's under a huge amount of pressure globally in all its operations. And we're also seeing that South Africa's lagging the rest of the world in recovery and moving out of this recession, and that's illustrated by the job cuts we've seen from Sappi now, where we've seen those pressures already 6 to 8 months ago in the US from Sappi's operations.